I have Lincoln Ellis with me right now. He's Chief Investment Officer at Strategic Financial Group. He manages directly, personally, $400 million, $1 billion about that he consults on. And you have, Lincoln, what you say is a strategy that's well suited to these times, really whether we deal with this debt ceiling issue or not, right?
Yeah, we wanted to really put together a thesis that was built around the productive thesis that we had started off the year talking about, and that was to focus on things that would be longer-term investable and that would sort of insulate investors from this sort of near-term macro thematic exogenous forces. So what we
we're talking an equity investment portfolio here of staples, utilities, industrials, and technology.
That's right, and as you nicely pointed out, that suits the kind of investing climate that we see. Staples, very much a theme along the soft patch that we're seeing right now. Utilities, maybe a longer duration kind of climate change. The industrial piece, really banking on continued growth in the emerging markets, although we do see some of that slowing down. And then technology, both in the cloud and on the consumer side, really the place where we've obviously seen growth in the market this year, but where we think we will continue to see productivity gains for years to come.
What do you think about if we sort of focus down onto what's going on right now? All of a sudden we're seeing finally the reality of the debt ceiling debate, it looks like, hit the stock market. How serious can this play out?
Well, the implications of any kind of default are obviously quite significant, but the longer-term confidence impact that we are starting to see emerge in the markets today is what we would be more concerned about. You see that reflected over the course of the last couple of days, not so much in equities and not so much in bonds, but really in the U.S. dollar. And although Julie points out nicely that once the fear train really gets going, the dollar does actually have a little bit of legs to it. You could see investors really shunning and voting with their anti-dollar trade over the last couple of days.
So, Lincoln, let me just kind of continue on what Matt just asked you. I mean, are you not surprised to see more market fear at this point? I mean, yes, we're starting to see it play out in the equity trade in the last half hour or so, but for the most part, we're not seeing catastrophe in the markets. Is that surprising?
It's very surprising, and in fact, the tone and tenor within the exchange, both here and in Chicago, seems to be very complacent. And only really in the last half an hour have we seen any kind of emergence of that fear factor. There's very much a sense that there's a deal that will get done. There's very much a sense that the game of chicken will be completed without injury. And I think perhaps investors, both institutional and individual, are beginning to sort of pull their bids back and perhaps bide their time.
It's the cash move that might be the scariest right now, right? The dollar rising because, of course, when you liquidate assets to go risk off, including treasuries, which are supposed to be a safe haven, you're going to the mattress and you got to hold dollars there.
Right. So the trade over the course of the last couple of days has been out of dollars into yen, Swiss franc, interest rate differential trades like Kiwi dollar and Aussie dollar, and of course gold. And that gold hitting a record high today, and all of these things stretched for the last 3 to 4 weeks, really people coming back to cash, and cash in this market equals dollars.
Do you look at, though, I mean, with your new thesis, and you've been investing in this since the beginning of the year, do you look at a day like this as a buying opportunity? Because if you want equities, you're getting them a little bit cheaper today.
Yeah, and probably not yet. I mean, NASDAQ, remember, just making new highs only a couple sessions ago. The Dow really performing quite well throughout the course of the year. And we expect, you know, reflective of the durable goods orders today, that there is this soft patch here, that we do have a question about whether or not what we're paying for equities right now is in fact fair value. So we'll continue to wait and step aside here for a little while and keep some cash.
All right. Hey, Lincoln, thanks so much for joining us. Lincoln Ellis there from Strategic Financial Group. We're going to